Stocks rebounded today after a volatile start to the year. The Nasdaq closed up more than 1.4%, but it's nearly 7% below its all-time high. Joining us now, Cantor's head of equity derivatives and cross assets, Eric Johnston. Eric, great to see you. Thanks for joining us. I mean, looking through your recent notes, I guess you weren't surprised by the early year pullback in general. Give us your take now. Still expect further pullback from where we are?
I do. I think we're actually going to see a pretty material sell-off over the next, 6 to 7 weeks. And there's really 4 main reasons, why I think this is going to happen. The first one is that this is really a historic change in monetary policy that no one has ever seen before. The Fed bought $4 trillion of assets over the last 2 years. They bought $1.3 trillion of assets over the last year. Rates have been pinned at zero, and the Treasury actually pulled about $1.6 trillion last year from the deposits at the Fed. This is now going to all be completely reversed this year. And although the market is aware of it, because this has never happened before to this magnitude, the market is unaware around how equities will actually handle it. We think it'll be pretty negative. The second thing is that equity exposures right now globally are at historic highs. If you look at equity allocations here in the U.S., they're at the highs. You can look at short interest, that's a percent of the market cap. That's at multi-year lows. And if you look at margin debt, how much investors are borrowing to buy more stock, it's increased by 80% over the last year and a half to 2 years. So we think that when the market sells off, there will not be an incremental buyer because they're full and they're impaired. And then quick last 2 points would just be that with yields moving higher, the TINA argument is starting to fade. We think yields globally will continue to move higher. And then finally, we're actually seeing early signs that the consumer, who's really been, incredibly powerful part of this economic rebound, is going to start to fade over the coming months for a number of reasons. So for all those reasons, we think the sell-off can be somewhat material, and it will gain steam as the momentum comes out of the market.
And so, Eric, what do you make of the bounce over the last couple of days? I mean, essentially, the S&P got to 5% from its recent highs. The Nasdaq comp 10% almost from its recent highs, and they bounced pretty aggressively over the last 2 sessions. Does that make you lose confidence in your call that we're going to see further weakness?
It does not. It's clearly a very jittery market. Risk levels at the hedge fund side have been taken down a fair amount. So you will get some of these, short-term bounces. I think one of the things in front of CPI tomorrow is there's a view in the market that the whisper number is very high, and that this could be a better than feared number. So I think that was part of the rally. I think if we do get any sort of pop in the morning, there will be a sell event. But no, I think there's going to be volatility. It's likely not going to be a straight line down. And really, I think this whole year is really going to be a trader's market.